Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. The Federal Reserve's March 18th rate hold has reshaped the Treasury landscape heading into April, and the volatility we're seeing across the curve is creating tactical opportunities traders need to understand right now. The FOMC voted 11 to 1 to keep the federal funds rate at 3.5 to 3.75%, with the 10-year Treasury yield immediately spiking to 4.265%. That's a 6 basis point move that signals markets are repricing their entire 2026 rate path. Here's what matters for your positioning. The yield curve spread between 2-year and 10-year Treasuries compressed to just 0.49%. That's significantly below the historical average of 0.8%. And it's telling you something critical about how markets view growth and inflation dynamics ahead. According to CNBC's reporting on Treasury market movements, this compression happened as the 2-year climbed to 3.775%, while the 10-year pushed higher to 4.265%. The Fed's statement revealed sticky inflation readings consistently above expectations, geopolitical uncertainty from ongoing Iran conflicts disrupting the Strait of Hormuz, and slightly upward growth revisions for 2026. This isn't a dovish hold, it's a hawkish pause with persistent inflation pressures keeping the committee cautious. The lone dissent came from Fed Governor Stephen Miran, who favored a 25 basis point cut despite these conditions. That internal debate matters because it shows you the range of views inside the committee. As Chase Investment Research noted in their analysis, this dissent signals ongoing policy tension between growth concerns and inflation persistence. Let's talk about what's driving this inflation stickiness. Energy prices remain elevated thanks to Middle East geopolitical risks. Disruptions in the Strait of Hormuz continue feeding upward pressure into headline readings, making it harder for the Fed to justify near-term easing. Consumer price index and personal consumption expenditures, data to keep surprising to the upside, reinforcing the committee's wait-and-see approach. Now, the trading implications. The 10-year yield at 4.265% is testing critical technical resistance between 4.0 and 4.4%. According to data from Y-Charts tracking Treasury rates, this level represents a key inflection point where aggressive moves in either direction become probable based on incoming data. The compressed curve spread of 0.49% creates two distinct tactical setups. Steepener trades benefit if we see sustained growth momentum, geopolitical developments increasing long-term inflation expectations, or Fed communications suggesting extended higher rate periods. You're betting that spread widens from current levels as the 10-year yield rises faster than the 2-year. Flattener trades work if economic data shows deceleration, geopolitical tensions ease, or markets reprice aggressive Fed easing expectations. You're positioning for that spread to compress further as short rates rise relative to long rates or long rates fall faster. Duration positioning requires careful consideration right now. Long duration exposure is vulnerable to further yield increases if inflation stays sticky or geopolitical risks escalate. Short duration strategies may benefit from continued hawkish Fed positioning, but you're exposed if data suddenly softens and markets price in faster easing. Barbell strategies let you capitalize on curve dynamics while managing overall duration risk by holding both short and long maturities. Cross-asset implications are intensifying. Equity market sector rotation is accelerating as rate-sensitive sectors reassess duration risk. Financial stocks are positioning for a potentially higher for longer environment, while mega-cap technology companies are reportedly implementing duration hedging strategies to moderate volatility exposure, according to analysis from Carey Street Partners on market positioning. The cryptocurrency correlation with traditional risk assets has strengthened significantly. Bitcoin fell below $72,000 following the Fed announcement, showing digital assets are increasingly influenced by monetary policy decisions. That correlation intensification means crypto traders need to monitor Treasury yields and Fed communications just as closely as equity and bond traders do. For April trading strategies, Economic data dependencies become critical. Monthly inflation readings from CPI and PCE reports will drive repricing across the curve. Employment market developments matter because persistent labor strength supports the Fed's cautious stance. Consumer spending patterns indicate whether growth momentum continues justifying higher rates. And obviously, any geopolitical developments in the Middle East directly impact energy prices and inflation expectations. Fed communication schedule ahead includes regional Fed president speeches, potential congressional testimony, and economic symposium appearances. Forward guidance evolution will be essential for understanding whether this hawkish hold represents the new baseline or a temporary positioning ahead of eventual cuts. Current market positioning creates vulnerabilities traders should monitor. Consensus long dollar positions are vulnerable to dovish surprises if data weakens unexpectedly. Short volatility positioning across asset classes leaves investors exposed to sudden repricing events. Crowded yield curve trades become susceptible to technical reversals as positioning gets one-sided. Liquidity considerations matter more in volatile environments. Maintaining adequate cash reserves lets you deploy capital when opportunities emerge during volatility spikes. Portfolio liquidity buffers protect against forced selling during stressed periods. And monitoring market depth across key Treasury benchmarks tells you how easily you can enter and exit positions at size. Risk management frameworks need to account for intensifying cross-asset correlations. Traditional diversification benefits potentially diminish when stocks, bonds, and crypto move together. Concentration risk builds across seemingly unrelated positions if they're all driven by the same Fed policy expectations. Tail risk scenarios can affect multiple asset classes simultaneously, amplifying portfolio volatility. The technical picture on the 10-year yield shows resistance at 4.4% with support around 4.0%. A break above resistance opens potential for a move toward 4.5% or higher, especially if inflation data continues surprising to the upside. A breakdown below support could trigger a rally back toward 3.8% if growth concerns emerge or geopolitical risks ease. Sector rotation patterns in equities reflect this rate environment. Financials benefit from steeper curves and higher absolute rate levels, supporting net interest margins. Technology faces duration headwinds as higher discount rates compress valuations on long-duration growth stocks. Energy remains supported by geopolitical risk premiums, keeping crude prices elevated. Utilities and real estate investment trusts face pressure from higher yields and reducing the attractiveness of their dividend yields. The bond market's repricing of 2026 Fed expectations shows markets now see fewer cuts than previously anticipated. According to reporting from Yahoo Finance on bond market positioning, oil price surges from geopolitical tensions have flipped earlier Fed easing bets, forcing traders to unwind positions built on assumptions of multiple rate cuts this year. Volatility positioning across fixed income markets shows elevated implied volatility on Treasury options, indicating uncertainty about the path forward. That elevated volatility creates premium selling opportunities for traders willing to take on risk, but it also signals the market expects continued large moves in either direction. The inflation versus growth dynamic remains the key driver. If inflation stays sticky while growth holds up, the Fed maintains this hawkish posture and yields potentially move higher. If growth falters while inflation persists, that's the stagflation scenario, creating the most challenging environment for all asset classes. If inflation finally moderates and growth continues, that's the soft landing, allowing Fed easing and potentially rallying both stocks and bonds. Your April playbook needs flexibility built in. Watch CPI and PCE releases for any signs inflation is finally rolling over or continuing to surprise higher. Monitor employment reports for labor markets softening that could shift Fed calculus. Track geopolitical developments in Iran and the Strait of Hormuz, since energy price moves directly feed inflation expectations. And pay attention to Treasury auction results showing foreign and domestic demand patterns that impact yield levels. The 0.49% curve spread represents opportunity if you have conviction on direction. Historical mean reversion suggests eventual widening back towards 0.8%, But timing that move requires reading incoming data correctly. The risk is the curve compresses further if recession fears build, or even inverts if aggressive Fed tightening expectations develop. Bottom line for traders, the Fed's March hold at 3.5 to 3.75% has established a complex environment characterized by compressed curves, heightened geopolitical risks, and intensifying correlations across assets. The 10-year at 4.265% and the curve at 0.49% and create multiple tactical setups across duration, curve positioning, and cross-asset trades. Success requires attention to technical levels, robust risk management, and flexibility to adapt as geopolitical and economic conditions evolve rapidly. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.